$35,750. That's a massive number, right? Well, if you happen to fall into a very specific age bracket, this is the brand new, totally supercharged retirement contribution limit for 2026. Let's get into it.
Welcome to The Explainer. I'm absolutely thrilled to be your guide today as we demystify these dense and, let's be honest, kinda confusing IRS limits for 2026. Our goal here is simple. We're going to navigate the weeds of the tax code together and turn all these updates into a crystal clear, actionable playbook for your financial future. Here's our roadmap for today. We're looking at the new limits for 2026, the big showdown between traditional and Roth, a deep dive into the 401k and the IRA, and finally some heavy-hitting strategies for high earners. So let's jump right in. Section 1. New limits for 2026. Bigger numbers, new rules.
Now, what's really fascinating here is that brand new tier sitting right at the bottom. For 2026, standard contributors under 50 can put $24,500 into their 401ks. If you're 50 and older, you get a solid bump up to $32,500. But look at ages 60 to 63, you get a brand new super catch-up provision allowing you to contribute a staggering $35,750. That is a real game changer. But hold on, because there's a major new rule attached to this, courtesy of the Secure 2.0 Act. If you earned over $150,000 in wages from your employer in 2025, your catch-up contributions in 2026 absolutely must be made to a Roth account, period. High earners literally no longer have the luxury of choosing pre-tax deferrals for those extra catch-up dollars. Moving on to Section 2, Traditional versus Roth, the ultimate showdown. At the end of the day, it all comes down to one simple, unavoidable question. Do you want to pay the IRS right now, or do you want to pay them later? I want you to actively think about your own career trajectory here. Do you expect to be in a higher tax bracket right now, or later, when you're finally sitting on a beach in retirement? Let's contrast the mechanics of this. Traditional means you make pre-tax contributions today. That lowers your current tax bill, which is great, but you face taxable withdrawals in retirement. Roth is the exact opposite. You make post-tax contributions today, meaning you pay the income tax up front, but you get glorious, entirely tax-free withdrawals in retirement. Look, we all know death and taxes are guaranteed, but paying taxes twice on the exact same money, that absolutely doesn't have to be. Which brings us to a quick refresher on RMDs, or required minimum distributions. Basically, these are mandatory taxable withdrawals that the IRS literally forces you to take from your traditional accounts, usually starting at age 73 or 75, depending on your birth year. You can think of RMDs as these forced tax events just constantly looming over your traditional accounts. Let's drill down into Section 3, deep dive into the 401k, the workplace battleground. Looking closely at workplace plans, the traditional 401k is fantastic because it reduces your taxable income right off the bat. But the Roth 401k offers this massive, totally legal loophole. There are absolutely zero income limits to participate. No phase-outs, no income caps. That means even the highest-earning executives can pump after-tax money into a Roth 401k, which, as we'll see in a minute, isn't the case with other accounts. And honestly, it gets even better. As of 2024, Roth 401ks are now completely exempt from required minimum distributions during the account owner's lifetime. They've finally aligned this rule with Roth IRAs. This eliminates those forced lifetime withdrawals and makes the Roth 401k an absolute powerhouse for keeping control of your taxes in retirement. All right, shifting gears to Section 4, deep dive into the IRA, the individual arena. Just as a quick reminder, your MAGI, or Modified Adjusted Gross Income, is the calculation the IRS uses as a gatekeeper. It determines if you're even allowed to contribute directly to a Roth IRA in the first place. So the crucial point here is how high earners get phased out of making those direct $7,500 Roth IRA contributions. For 2026, if you're single, your eligibility phases out between a MAGI of $153,000 and $168,000. If you're married filing jointly, it phases out between $242,000 and $252,000. Earn above those top numbers, the front door to a Roth IRA is completely locked. Traditional IRAs, on the other hand, operate a little differently. Anyone with earned income can contribute up to that $7,500 limit, or $8,600 if you're 50 and over. However, if you or your spouse are covered by a workplace retirement plan, your ability to actually deduct that traditional IRA contribution from your current taxes phases out at higher income levels. So you can always put the money in for sure, but you might not get that upfront tax deduction.
Now for the fun part. Section 5. Strategies for high earners. Putting it all together. This brilliantly illustrates one of the best moves you can make. As Kiplinger notes, Roth conversions can be a powerful tool, especially during early retirement years, to fill up lower tax brackets. Instead of getting hit with massive RMDs in your 70s, you can systematically convert traditional funds to Roth over time. You pay taxes deliberately at lower rates right now, just to avoid those massive, unpredictable tax spikes later on. It's like solving a giant puzzle before the pieces even drop. Then there's legacy planning, which is governed by the Secure Act's 10-year rule. If you leave a traditional account to a non-spouse heir, like your kids, they have to empty that entire account within 10 years. That can trigger a sudden, extremely painful tax burden right during their highest-earning professional years. But if you leave them a Roth account, they receive entirely tax-free growth and distributions. The whole shebang, completely tax-free. Let's break this complex decision-making process down into 3 highly actionable steps. Number 1, evaluate your current versus future tax brackets. Number 2, plan ahead for those looming RMDs and your overall legacy goals. And number 3, consider splitting your contributions between Roth and traditional. Having both gives you a flexible, balanced hedge against future tax uncertainty. Because let's face it, we don't know exactly what tax brackets will look like in 20 years. As we wrap up this explainer, here are the 3 absolutely critical takeaways to anchor into your memory. First, utilize that massive new $35,750 limit if you're in the 60 to 63 age bracket. Second, if your 2025 wages were over $150,000, prepare for your catch-ups to be mandatory Roth contributions. No way around it. And third, actively use Roth strategies today to diffuse future RMD tax bombs tomorrow. I want to leave you with this one provocative thought to chew on. What is your 2026 strategy to pay the IRS less and keep more of your hard-earned wealth? Thanks so much for joining me for this explainer. Take these insights, review your finances, and let's make 2026 your absolute most strategic financial year yet.